I am selling an $800,000 fourplex building with the loan half paid off. Why not just keep it and pay it off? This right here defines the difference between a scarce mindset and an abundance mindset. Hi, I'm Keith Weinhold. This is Get Rich Education. In the last video, I talked about the operations and the cash flow of this very 8-unit residential apartment building that you're looking at right here. This is a building that I currently own. It's under contract to sell. But let's expand on the leverage portion of what's motivating me to sell this profitable building. A lot of people, I think, would hold on to this 8-plex and work hard to pay down the loan and stay small and think, I want to get debt free on this building. What an awesome feeling it would be to have the loan on this building paid off. This right here is the difference between one wanting to be debt free and one wanting to be financially free. Trying to get this building paid off would actually move me away from financially free, which is what I really want and probably what you really want, rather than being debt-free. So what does debt-free mean? Debt-free simply means that you don't owe anyone anything, but you typically work really hard and trade your time for dollars to get in that position, and you forego the opportunity cost of borrowing at a low rate like you can today and investing at a higher rate. But that's what debt-free means. You don't owe anyone anything. Financially free, I think that's where you really want to be. That means you have so many passive income streams that you can do whatever you want to do whenever you want to do it. That's aspirational, and that's why I say that financially free beats debt free. So do you think you could be financially free if you held on to this building and you're only ever having 8 doors in this part of your portfolio, and therefore you're only serving 8 families? Or trading this building up like I'm doing, where I can perhaps serve 20 families and provide good housing to 20 families. Instead, capitalism rewards those that provide more value for more people in society. So rather than have this 100% paid off here, this 8-plex, I'd much rather have 5 properties like it that are all 20% paid off. Now I really have the ability to magnify my wealth. In fact, the wealthiest people have the most debt. There are so many examples of this. Mark Zuckerberg and his wife, that could afford to pay cash many times over for their primary residence, went in and applied and got a mortgage for their property. That's leverage. Now there's bad debt and good debt. Bad debt is debt that you have to pay yourself. It might even be unsecured and at high interest rates. We're talking about good debt here. So if I were to work hard, say, and make extra principal payments to try to pay off the loan on this 8-unit building and just keep this building, basically here's what I'd be saying. Hey, Mr. Banker, here's a $1,000 extra principal payment. Don't pay me any interest on it. If I need it back, I'll pay you fees and I'll prove to you that I qualify again. Here's a $1,000 extra principal payment. Don't pay me any interest on it. If I need it back, I'll pay you fees and I'll prove to you that I qualify again. That doesn't make any sense, especially at today's low interest rates. Also, what I would be doing is then I would be converting cash into equity. Financial freedom is achieved by doing the opposite thing and converting equity into cash flow. I would also lose leverage if I would pay down the principal, and I'd also be tying up more of my own money in just one property. That doesn't make a lot of sense. It's not expansionary. That's contracting, staying small, and safe. The ancient Greek mathematician Archimedes said, if you give me a lever and a place to stand, I can move the world. Now, Archimedes was talking about geometric and physical leverage there, but the same applies here with this concept of financial leverage. So let's look at how much leverage you're getting in your portfolio. Let's turn this example over to you. Your leverage ratio is your property value, or the combined values of all your properties, divided by all of the equity that you have in your properties. So if your property's total value is, say, $1 million, and you have $400K of equity in all of your properties, Then your leverage ratio is 2.5. You can also say that is 2.5 to 1 expressed as a ratio. This can also be thought of as your wealth multiplier, this leverage ratio. You're trying to increase that leverage ratio, so you're using the borrowing power of other people's money, the bank's money, and getting return on their money, not just your own. Now, can one get over leveraged? Can one borrow too much? Yes. The definition of over leveraged is when you borrow so much that your tenant income, your cash flow from those residents, can't cover those recurring costs that you have every month. So you do want to avoid being over leveraged, and you want to buy where your rent income exceed all the property's expenses, including that mortgage principal and interest. Don't get over leveraged. Now, in the last video, both here on YouTube and off YouTube, some people said, well, can't you just hold on to this building and do a cash out refinance? Yes, that is a good point. But like I mentioned in the last video, I can only keep 30% equity in the property minimum. That would make my leverage ratio about 3.3. So if I pull it all out by selling it, which is the only way I can get all that equity out, and reposition it with a 20 to 25% down payment in another property, that's 4 to 1 or 5 to 1 leverage. And there's really another component of this. We've only been talking about one property, but as a real estate investor, you soon learn what's actually more important than the property, and a lot of people never learn this. The market is more important than the property, because this 8-unit property or any rental property you buy is swimming in this economic sea where you need population growth and job growth and wage growth in an area, have a vibrant economy, and have tenants that are going to be able to pay the rent over time. This particular building is not in a very diversified economy. It's in Anchorage, where the oil drives almost the entire economy. It's not even as diversified as, say, Houston, another oil city, is. And I have too much of my portfolio weighted in this oil-centric economy, so I'm looking to diversify and move these dollars out of market. I can't do that very well merely with a cash-out refinance. The market's more important than the property. And you kind of inherently know this. A castle in a swamp is worth almost nothing, but yet a tiny efficiency apartment that's well placed in the Tribeca section of Manhattan is going to go for a huge sale price or rent amount. The market's more important than the property. But getting back to this concept of leverage, instead of only having 50% equity in this 800K building, I can do this tax-deferred exchange, also called a like-kind exchange, and move my 400K of equity and position it with a 20 to 25% down payment onto a $1.5 to $2 million building or so. When I do that, no equity is lost, except a corner's chipped off for agent commissions and make-ready expenses. Equity is merely transferred from one property to the other, and now I also get the benefit of geographic diversification. So therefore, maybe if I can get a 20-unit building, I could control 20 doors rather than only 8 doors when I do this exchange. And you know, the scarce mind would pause, and they might say, well, wait a second, you're taking on more debt. Instead of now having the ability to have just a 50% loan on an 800K property, you might have a 75 to 80% loan on up to a $2 million building. Whoa, I don't know if I want to take on all that debt. Again, financially free beats debt free. My debt is completely outsourced to tenants as long as I bought for cash flow. So look, if the market appreciates 5% on, say, this $800,000 building that I would keep if I chose to keep it rather than selling it like I am, well, 5% on 800K, that's just a 40K gain. But on a $2 million building, that's a $100,000 gain. So with leverage and owning more property, I could have a 100K gain or a 40K gain. Again, I want to trade up to that larger building. Get financially free. This gives me more cash flow, more doors, I'm serving more people, and I get more tax benefits at scale with a larger property. So I can have 4 to 1 or 5 to 1 leverage on a big property rather than just 2 to 1 leverage on a small property. I'm really telling you here how wealth is created. Use leverage to trade up or do a cash out refinance. Now, Some people might think, now, Keith, where did you ever get the money for this eightplex? You're not a very old guy. Like, where did that ever come from? Because I bought it with a 20% down payment in the first place on this eightplex. You might know the answer if you think about it. I just did one of these like-kind exchanges from accumulated equity in a fourplex building up to this eightplex building, and next we'll go into 15 or 20 units, and people might say, yeah, how did this guy come up with this money, with this down payment, and control $1.5 million or a $2 million building all by himself? The short answer is, where did I get the money? It's leverage, leveraging the bank's money. You want to keep employing and using other people's money. You're doing that 3 ways at the same time ethically. You're using the bank's money for this leverage we're talking about, the government's money for tax benefits, and the tenant's money for the cash flow that controls the mortgage on that leverage. You're using other people's money 3 ways at the same time. That's the effect that you want to optimize. And that's how I drop that heresy when I say that compound interest is lame. Leverage is what builds wealth. With compound interest, you're typically only using your money, and then the rate of return from compound interest, although it looks amazing and parabolic on a chart, is worn down to nothing after you factor in inflation, emotion, and taxes, and fees, and volatility. Some of those 5 factors actually help the real estate investor. You want to learn how to use inflation, taxes, and leverage to get wealthier, not poor like you do with inflation and taxes when you're just invested in mutual funds and you're pinning your hopes on mere compound interest. You're only using your money if you do that. So to wrap it all up for you, now that you have more context, why would I ever sell a cash flowing property like this eightplex that we've been talking about? Well, in order to buy a bigger cash flowing property and create more leverage. Hey, put a YouTube like on this video if you would. You don't have to, but that tells YouTube that's a good video, and it'll help ensure that you do see more videos like this in your feed, and point other people to this video about why financially free beats debt free. I'm Keith Weinhold. We'll see you in the next video. Thanks so much for stopping by.